We are continuing our breaking news coverage of the Bank of Canada's latest interest rate decision. Now, the bank held rates steady at 5% this morning, continuing a trend we've seen for several meetings. But for the first time, the bank indicated it won't need to increase rates again if the economy evolves in line with its own forecasts. Officials saying the data shows economic growth has stalled, will remain slow in the near term. That should help bring inflation back towards the bank's target level heading into next year. We are going to hear from the Bank of Canada Governor Tiff Macklem coming up at 10:30 Eastern Time. There is a press conference scheduled. In the meantime, we've got a great panel here on the open. Sticking with us from last hour, Don Desjardins, chief economist at Deloitte Canada. We're also joined by David Wolf, portfolio manager at Fidelity and former Bank of Canada advisor, and Ed Devlin, founder of Devlin Capital, former head of Canadian portfolio management at PIMCO. It's great to have you all with us here. Don, I'll come back to you. We were covering the breaking news 15 minutes ago, and for the first time, we're seeing more of an indication that the bank is leaning towards rate cuts without going all the way there. What is the balancing act that's at play here right now?
Well, it is the idea that, we're in a slow growth environment. Inflation is not performing exactly the way they'd like, but certainly we have seen significant improvement on the inflation side. I think it comes down to, and to some degree, inflation expectations. When we looked at the Bank of Canada survey from the consumer side, it's not until 5 years out that consumers expect inflation to get in that lower, in that band of 1% to 3%. So I think that's a little concerning from the point of view. It's quite sticky from the consumer side. On the business side, they say we'll probably see a 2.7% inflation rate 2 years forward. So a little better, a little closer. But certainly, I think that is something, along with the wage growth, of course, wages being a little stronger than most of us, I think, anticipate. And we do think, like the bank, that wage growth will decelerate as we work our way through 24.
Ed Devlin, how's the market supposed to react to something like this?
Well, I think this is pretty much as expected. The one thing that I've been keeping my eye on, and I think it'll be something that they're going to have to address at some point, is the balance sheet. I think right now the market's pricing in 100 basis points of rate cuts this year, starting in kind of June. That kind of lines up kind of with my expectations. So for the last little while, I've been saying buy bonds, yields too high. I kind of looking at them a bit more fairly now, I think, in terms of rate cuts priced into the market. The thing I think is going to be really interesting to watch is there's a huge supply of bonds that need to be bought because the bank is no longer refinancing the deficit like they used to. And they're going to have to be picked up by folks like David and and myself and others, and that is a completely different yield than where the bank would buy them. And so that is, to me, a wall of supply. By the way, it's not just a Canadian thing. It's a little worse in Canada, but it's the Fed and everywhere else. And so if you think, the way I think of it kind of conceptually, I think of it like we're a little bit in the world of Japan, the Bank of Japan. You know how they had to yield curve control, so they have to control. They have a policy rate, but they also are targeting further out the curve. I don't think they'll do yield curve control, but just the size of the balance sheet will be affecting it. And so I don't think they can ignore that until, say, they've dropped their rates to the point where they want to. I think they have to address it before then.
So just because there's a PIMCO connection between you and Bill Gross, who was making headlines yesterday tied to the U.S., and he seemed to be indicating that idea of so-called quantitative tightening is something that the Fed should rethink. I guess if we're thinking about it just in terms of the economy itself, if the Bank of Canada is moving away from basically being a support with its balance sheet, how should they think about it, going forward?
So I'd love David's thoughts on this, but I was going to say the way I kind of think about it is what the central banks tend to want to do is just use monetary, like their policy rate, as their main tool, and then maybe use forward guidance or some chatting to the market, and that's traditionally what they do. Unfortunately, they've been put in this situation where they have these massive balance sheets, and I think what they normally would like to do is run the balance sheet back to where it was before, and then just use the policy rate up and down. And I think, given the structural nature of the deficits that we have, there is a fundamental mismatch between supply and demand, I think. And so what you could easily see is the policy rate, if they don't address it, you can see a policy rate dropping and term rates not. And then next thing you know, you're not going to get the easing you want. So there has to be an adjustment that has to be made. And this is, like I said, the Bank of Japan's already dealing with it. We've got to find a way to deal with it.
Over to you, David Wolf.
So first thing I'll say is I'm still stuck on Ed's comment about us looking like Japan. I mean, that's not really a great comparison given what Japan has been through for the last 30 years, and that's a pretty daunting thing. If
I don't think we'll become Japan. I'm just saying it's two policy tools. That's all I'm saying.
Yeah, no, and that's quite right. I think one thing I want to return to is this notion that the bank thinks it's done, and they took out, as you mentioned earlier, the statement about being prepared to raise rates further. That's not in there anymore.
Yeah.
And I think that's a pretty clear signal that they think they're done. The caution I would give is the bank did exactly the same thing a year ago, as you remember. So January 2023, the bank basically signaled, we think we've done enough, that rates have gotten to a point where we think the economy will slow sufficiently to bring down inflation. That's all fine. And they were wrong, which is fine, because you never know what's going to happen in the future. But as you'll remember, in June, the bank resumed raising rates because they thought they had done enough, and as it turned out, they hadn't done enough. And so the same thing can be true here. So we have to be very cautious about interpreting their statement or their implication that tightening is done with a firm conclusion that it's actually done. I don't think they're going to raise rates further, but we can't be certain of that.
And is inflation ultimately the determining factor there?
Inflation is the determining factor. It's the target for the Bank of Canada. It's what they're focused on achieving in terms of that 2% target over the medium term. And the growth environment is really just a method of getting to that inflation target. And a way to think about that is the bank is forecasting basically a stalled economy and some rebound into the latter half of this year and then into 2025. They think that is associated with inflation to target, but it may be, and this is my personal suspicion, that you actually need something quite a bit weaker than that in order to return inflation to target, given, as Don mentioned earlier, the stubborn stickiness in shelter price inflation. We can talk about that.
Yeah.
In wages, the underperformance of productivity, et cetera. So this is what they think is going to happen, but we shall see.
Okay, so let me start to piece some of this together with all of your own expectations, tying it back to the market. So, Don, we were talking before the break about how it sounds like you wouldn't be surprised if come April the bank was, let's say, ready to cut rates. Already today we've had a discourse on how aggressive the rate cut campaign could look like this year. We had Carl Schmidt on last hour. He was talking about maybe 3 25 basis point moves this year, but you were saying 100 basis points is
what's priced in.
Is what's priced in.
Yep.
And I would assume each of those is like 25. So the market is thinking
starts in June and does 4 rate cuts by December.
And so I guess going back to David's point, we got to watch the inflation front. But David, don't we also have to watch, if we were to go beyond that amount, if that's a reasonable expectation by the market, and I guess that's up for debate as well, would that indicate a notable deterioration in the economy itself if they were going to go further than that?
Yeah. I mean, basically, the bank lays out its forecast as here's what we expect on growth, here's what we expect on inflation. And if we get something different, then their reaction is going to be different. So the bank is forecasting basically zero growth over the next couple of quarters. If that's weaker, if we get negative numbers, that will bring forward whatever their expectation is on easing. The other thing I'll mention, and it's something that I don't think is very well understood about the way the forecast is put together. There are rate cuts in their forecast. They don't tell us what they are and how much, but the way the forecast is put together, you have the economy in balance and inflation on target at the end of the forecast period. So really what's moving around in there is what the bank thinks it has to do in order to produce that recovery in demand, going from 0.8% growth this year to 2.5% growth. Now we know the current policy rate is 5. The bank thinks that neutral is probably 2.5. So to get to that nice balanced inflation on target environment in a couple of years, you need the policy rate to be going towards neutral, maybe not all the way to it. So that's, 200 basis points of rate cuts. We don't know, and this is an issue that I've had with the bank for 20 years in terms of, it seems to me that if you're giving a forecast of growth and inflation that's conditioned on a reaction of monetary policy, you should tell us what it is. And the Fed does that, and other central banks do that. The Bank of Canada doesn't do that, and I understand to some degree why, and it's an old fight. But the point is that I can say with certainty that between now and the end of 2025, the forecast that they're given includes some degree of easing in interest rates.
So just tying it back to the markets, Ed, you were talking about how you'd look at government debt today, given all this conversation we're having about where interest rates are tomorrow. You shared your view on what you would be locking in some debt products today based on your assumption that rate cuts are going down tomorrow?
Yeah, I was kind of pounding the table the last few times you and I have spoken, John, about buying bonds. Yeah. We've had a nice rally. Yields have fallen. They've come back a little bit now. Yeah. So I would still be overweight. I wouldn't be as overweight as I was a couple of months ago. But the other thing you have to respect is what David just brought up is, the short-term inflation is really hard to forecast. Yeah. And there's a lot of factors that Don brought up. They're quite sticky. So, in terms of being an investor, it was time to be quite long before, a little less long now, and a backup on yields. I'd probably get longer again, but I'd still stay a little bit long.
Okay. Oh, so on the inflation front, three really smart brains here. Don, what is the most challenging part of the inflation story? Because, every time we cover the inflation numbers these days, it feels like at least one consideration is what's happening with the inflation that comes from higher interest rates, mortgage-related inflation, or even just higher rental prices through what's happened in the mortgage market. And I know there's a bigger conversation for Canada about just not having enough homes. But what is the stickiest part of the inflation story that could lead to this choppiness that we're talking about this morning?
Well, I think when we're looking at it from a global perspective, we've seen lots of uncertainty recently, whether it's in the Middle East or the Red Sea. We have lots of things that could disrupt our supply chains, which could lead to another bout of higher prices for energy, for food. So, these things are out of the control of the Bank of Canada. So they do remove those from some of their calculations to really get this underlying sense of inflation. And yes, it is the shelter story. But as you say, unless we have a lot of supply somehow we're hidden, we're going to continue to see this pressure on rents, for example, which are running at really fastest pace, I think, since the early 90s. So, there's a lot of stickiness in there, but they're also looking at trends below the surface. And that's where I think they worried a bit in December, because some of those trend rates that they were looking at, those core trend rates, they had started to burble up again. And that is not terribly comforting. Now, when you look at quarter over quarter, all of those rates have come down a bit compared to the third quarter. So that's the good news. But we're still in a situation where, we are seeing some components that are keeping our inflation rate higher than the bank desires. And go ahead.
Well, it got me curious. David, I'll ask you. So you referenced last January when the bank sort of made a move, and then ultimately that did not play out as was expected. Maybe it influenced the way they're thinking now. But we certainly did start to see renewed optimism in housing after that messaging a year ago. Do we need to be having a conversation just about everything that comes out of this central bank and what ultimately happens in the Canadian housing market as a complicated dynamic on its own?
Yes, it is a very complicated dynamic.
Okay.
So maybe a couple of ways to think about it. So the first is, as Don was suggesting, there are a number of different aspects to the inflation challenge. But to me, the key one is shelter. And the bank was pretty straightforward about that in the monetary policy report. This morning, it's accounting for, I believe it's more than half of total inflation at this point. And it is interest rates, but it's also rents. It's to some degree other costs of housing. And we understand why that's happening, which is We had already a pressured housing market situation. Then we brought in a whole lot of people, in many cases unexpectedly. And supply just is not very elastic in housing, so that's got to put pressure on the existing housing stock, on rents, on house prices, et cetera. And that's not something that goes away quickly. In fact, it's not something that changes at all very quickly. And so that's one of the reasons why the bank is concerned about the stickiness of inflation, that to Don's earlier point about global supply considerations, good prices, et cetera, those are coming down everywhere. And that's happening in Canada. But the domestic aspect, which is largely shelter, is going to be sticky. How sticky remains to be seen. But it's one of the concerns that the bank has with respect to if shelter inflation doesn't come down sufficiently, overall inflation is not going to come down sufficiently, and the bank is not going to be as able to ease as they'd like to be.
So, to your earlier point, the bank saying a stronger than expected rise in home prices is one of the main risks that could drive inflation higher than expected. But Ed, just back over to you, when you've talked about your belief that rate cuts are inevitable, you've talked about the mortgage dynamic of our housing market, the shorter duration mortgage market in Canada, let's say, versus the United States, the fact that over the next couple of years, we're going to see a lot of mortgages rolling over and sticker shock for a lot of Canadians who haven't really even experienced it yet. Correct?
Correct. So, yeah, I mean, I'm still in the camp that we'll have a recession this year. So, and I'm kind of in the camp that, and I'd be curious, David and Don, about your opinion, but that if you think of the risk reward or the risk profile of if you're TIF, if you're the Bank of Canada, you do not want to lose your inflation targeting credentials. And we had a little scare. It's not a Canadian thing. It was a global thing. But both the Fed and the Bank of Canada want to have that back. And so my base case is they over-tighten. And over-tightening could just be staying here at 5 for an extra couple of meetings when with the benefit of hindsight, we'll find out they should have cut. But because, you don't want to be the person and let the inflation genie out of the bottle, right? You don't want to go down as the village idiot of central bankers, kind of thing. And no one wants to do that after that. So I kind of think that's why being long bonds and long interest rates is a pretty safe way to be, because whether it happens in the next quarter or two or it happens near the end of the year, at some point, I'm pretty sure we're going to be right in this view. And so I don't know if you folks would agree.
Yeah, so I fully agree with respect to the fact that growth is likely to be weaker, and I do think that we may already be in a recession.
Exactly.
In Canada, and the numbers will show that over time. There's something different, though, happening with respect to that attitude that Ed was talking about at the Bank of Canada versus the Fed, and it has to do with the differences in productivity growth in the two countries. So in Canada, productivity growth has been very poor. And that means that the economy's capacity is not expanding significantly. And that makes it harder to get inflation down. And so the bank has to be weighing these factors, and Ed, you mentioned this, where if the economy is weaker, they want to cut, but if supply is not growing either, then they still have to be worried about inflation remaining sticky. Whereas in the US, it's a bit of a different phenomenon. Productivity has been great. The economy's capacity has been growing very nicely, and inflation has come down a lot. So the Fed, in some respects, I think, will feel itself freer to cut rates than the Bank of Canada will, because you have just a more favorable economic conjunction, in a sense, in the US than in Canada.